10 stocks that are at 52-week lows, and are these stocks a buy now, in my opinion? I'm be honest, I wasn't sure where to put this video, so I'm putting it on the reaction channel because I want to do a video that just covered a bunch of stocks that are 52-week lows right now. You might think, well, some stocks are doing tremendous right now. You see Tesla stock, you see Meta stock over the last several months, right? You see Nvidia, you see AMD, you go through a lot of those stocks, and it's like, my gosh, like it's amazing. But then when you look a little deeper in the market, there's a lot of stocks. I mean, a lot of them that are at 52-week lows right now, actually, okay? And so I want to go through some of these companies, kind of share my perspective, do just kind of base level research with you guys here, and kind of take you through this and just like some initial kind of look in with some of these stocks. So once again, I wasn't sure where to put this video, because I'm not going to put this video on the main channel, just looking into a bunch of different stocks here. And so reaction channel, you guys get it. I hope you enjoy it. I hope you get some good value out of it. Maybe you do, maybe you don't. I appreciate you showing up either way, and thanks for being here, folks. I appreciate y'all. Much love as always. Also, thank you every single person that gets value out of the channel and wants to support on Patreon. That's pinned comment down there. Tomorrow I'm making moves in there. I am buying stocks in there tomorrow, so if you want to see what I'm buying in there tomorrow, check us out in the Patreon. That will be pinned comment down there. We also have a Discord chat now available as well. Union Pacific, very surprising company to be hitting a 52-week low here today. Union Pacific, if you never heard of Union Pacific, where the heck you been, okay? Massive railroad giant in the United States of America. And when you look at this company, right, I mean, they have a needs-based business model. Let's just put it that way, right? Like, if you're talking about transporting anything around the United States of America, like, at some point in time, you're going to likely have to go through Union Pacific. So $113 billion market cap on this one, 16, almost a 17 PE ratio. Not very high, but also do keep in mind for the railroads, you don't usually have to pay up for those ones. Almost always you're going to find, railroad operators under a 25 PE ratio. Almost always. Not always, but almost always. Like, that's very common, okay? So, 17, pretty low there. A dividend yield approaching 3%, right? And if I had to guess, a company like Union Pacific ups their dividend almost every single year, right? And so if we want to go to historical data, this is actually a little hack here I'll show you guys to just easily see dividend history. So you go to dividends only, and then we can back it up, and let's just say over the past 5 years, apply. And now it's going to show us over the past 5 years their dividends they paid out, okay? So we see here they were paying out 73 cents. They went up to 80 cents and 88 cents and 97 cents for quite a while there. Then $1.07 just for 2 quarters, and then up to $1.18. Then we've been kind of stuck at $1.30 here for a bit, right? So clearly this stock is showing a history of upping their dividend more and more and more over time, right? If we want to back it up even further here, let's just back it up way back and just go over the last number of years, right? So we see they upped their dividend in 2007. They upped it in 2008, even in the Great Recession. That's surprising, but then they just kept it the same for 2009 into 2010. Then they up it again. I mean, look at that dividend increase over time. My gosh. I mean, that if you're looking at just dividend history, a company like Union Pacific is the perfect company to look at just constantly raising their dividend, doing a great job. So, right off the bat, that's pretty darn exciting in regards to this one, right? Now, let's look at a few statistics here around this one. So, forward PE around the same as trailing PE. My guess is why is the stock at 52-week lows? My guess is because essentially there's worries about recession, right? If there's worries about recession, well, then that's going to hit a company like Union Pacific, any railroad operators, right? So that's interesting as far as that goes. Price to sales ratio obviously significantly lower than where we've been kind of historically for the stock, right? And let's take a look at payout ratio for this one here. That's what I want to see next. Payout ratio 45%. Okay. Interesting. 45% payout ratio. Yeah, because I was almost thinking it might be higher than that when I was initially looking at the stock. Let's dive in here to a little financials. And we see 19 billion revenue, 21 billion, 24 billion. Cost of revenue, 10 billion, 11 billion, 13.6 there. Gross profit consistently going up for this company. It's impressive, man. 9.1, 10.5, 11.2 gross profit for the company. Operating income, a little surprising here. Operating income did not go up nearly as much as you might think. It went up about $600 million. Based upon that gross profit, you would have thought it would have, well, I mean, that's roughly in line. Looks like there's just cost of revenue kind of weighed them down to not make those numbers look as impressive, right? Net income attributable to shareholders, 5.3, 6.5, and about $7 billion. Very impressive. And if you look at the last 3 years of the income statement for Union Pacific here. As far as balance sheet-wise, sitting at $65 billion total assets, $53 billion of liabilities. Stockholder equity, about $12 billion on this company. And obviously, if we're looking more in depth, we look at every single line item, things like cash and cash equivalent, short-term investments, long-term investments, debts, all those sorts of things, right? But Union Pacific's actually looking interesting. Interesting for the first time in quite some time. If we go back, I mean, you could, this is $186 stock here today. I mean, that's the same it was prior to Rona. That's interesting, despite them doing great with their business. And, yeah, stock hasn't gone much of anywhere. Obviously, the good thing with a stock like Union Pacific, right, is let's say you've owned it over the last number of years. You've gotten very little capital appreciation on the stock as of right now. But do keep in mind it's at 52-week low, right? So I think it's a little unfair. But let's assume still that's the situation. Well, you're looking at a company here that you still made a ton of dividend money on. You know, have you got a great share appreciation over the years? Not really. But have you at least gotten a lot of solid dividend money in? Yeah. And eventually the stock's not going to be at 52-week lows anymore, right? And it'll do much better than that. So, yeah, interesting play here. It could be a potential dividend stock for me. But this next one's also a railroad operator. And this one could be more interesting. It might be worse than Union Pacific. That company is Norfolk Southern. Norfolk Southern, another big rail operator here. And this one is pretty darn, it hit 52-week low today as well in regards to this one, right? And this is another stock that has just had a lot of troubles. So in regards to Norfolk Southern, it's very similar yield to Union Pacific. It's slightly less, right? Lower PE, so that's a little intriguing there when it comes to this company, right? Let's go ahead and look at that dividend history for Norfolk Southern here. Let's take a peek over the last 5 years here and see what we find. So 72 cents, 80 cents, 86 cents, 94 cents. Wow, a lot of 94 cents there, 99 cents, $1.09, $1.24, $1.35. So that's impressive, man. Impressive. Now, when it comes to these companies, it's not like they're up in their dividend every single quarter, but also do keep in mind that I think they probably didn't up some of these quarters because of Rona was going on. That's my guess when it comes to some of these companies, right? Definitely, that's what I'm thinking around that, right? So same boat as Union Pacific in terms of not expected to have profitability go up over the next year, basically versus the last year. Price to sales ratio lower than Union Pacific. So it just seems like valuation-wise, you're getting this one for cheaper. Why that is, I don't know. It could be potentially it's not run as well. It could be potentially it just doesn't have, I don't know, as much of a liked brand. It could be many various things, right? Payout ratio, 35%. Okay, that's intriguing. So, I mean, if you look at just the metrics so far, this actually looks more attractive than Union Pacific, to be honest. It really does. There's got to be more to that meets the eye that you have to do big research on here. But I think that's very intriguing. If we go ahead and pull up the income statement here, 9.7, 11.1, 12.7, cost of revenue. Looks like cost of revenue went up less, right? We're at about a 1.2 difference there, but in terms of cost of revenue, but revenue was up about 1.6 or so, 1.6 versus 1.2 roughly. So or actually almost more like 1.1 there. So that's impressive. So gross profit 3.7, 4.7, 5.2 billion there gross profit. It's impressive. If we go ahead and take a peek at net income, 2 billion, 3 billion, 3.2. Not as impressive when it comes to the net income as it was if we look at something like obviously gross profit here. But they had this operating expense that hit there. So do keep that in mind. Other operating expense, $160 million. That was pretty significant. So anyways, that's an impressive income statement for this company. Balance sheet wise, we got to look at 2022, $38 billion, almost $39 billion in assets, $26 billion in liabilities. That's about a $12 billion difference here. So that's intriguing. I mean, you look at the market cap of this one, $45 billion, Union Pacific, $113 billion. I mean, it seems like Norfolk Southern, and you have to really go in depth if you're actually going to buy a stock like this, right? And really take an in-depth peek at these. But at face value, if I had to say, is Union Pacific a buy or is Norfolk Southern a buy? The one that looks like more of a buy is Norfolk Southern. But once again, you have to kind of get into the nitty-gritty here and really see what's going on with these companies, because there could be many various things. So that's intriguing, okay? Southwest Airlines is in the bad boy camp right now. Southwest Airlines has been absolutely obliterated, okay? And this is a stock that's right now literally 52-week lows, right? It's had an awful, last 5 years. Now, part of that is Rona. that has nothing to do with them. They got forced to basically shut down their business. But when you look at this company, that's awful. That's an awful, 5-year run there for the company. 5 years ago, the stock was $56. Today's 29. 5 years, and you lost that much money. Especially for a company that's supposed to be seen as a stable company. Now, about a 2.4% dividend yield, decent when it comes to that. Obviously, the dividends are not going to be consistent because we know this company basically had its business shut down in Rona, which, this isn't going to be the absolute low for the stock. It actually was lower than this, but $23 is what this Yahoo Finance chart has us at in regards to that, right? So you look at this one, super low forward P. It's under 10, so it's dirt cheap. It is an airline, so keep in mind airlines usually trade at, from what I've seen in my time in the market, almost always under a 20 forward P, and many times under a 15 forward P when you're in a normalized environment. Under 10, you're getting intriguing. I have to be honest. Like under a 10 for an airline provider like a Southwest. I know they had their disaster last year, but I gotta say that's actually relatively attractive. Now, in terms of their income statement, you can't get too excited because it looks tremendous the last 3 years, right? From $9 billion then to $15 billion to then to $23 billion. Looks like their business is soaring. But keep in mind, this is what it was prior to Rona, $22 billion. Okay, so it's like, wow, look at that growth, but it's not what it's all cracked up to be. Okay. Now, cost of revenue has been going up substantially, $10 billion, $11 billion to $19 billion last year. Ugh. Gross profit, 4.7. They did have a hit in the fourth quarter. They're going to have another hit in the first quarter, from my understanding, in regards to gross profit due to their whole situation they had in the winter time. So, if we look at net income for the company, 561. They had almost $1 billion in net income here, and then you go down to 561. And then, this year will be a little messy for them. It could be better, though. Total assets, $35 billion. Total liabilities, $24. Stockholder equity, $10 billion-ish, somewhere around there, roughly. So, for $17 billion, I got to say, Southwest is probably a buy here. Am I going to step in and buy Southwest? No. But if you buy Southwest, hold it for 5 years, are you going to make money? I would say extremely high probability. If you hold it for 3 years, are you going to make money? Probably pretty decent money. Is it going to be the best stock in the world? No. But you'll do pretty decent on that one, okay? Carnival Cruise Line, this is the only one that's not at a 52-week low that I added to the list, but I thought it was interesting because, they kind of almost fall into that same camp as, Love in terms of travel, right? But then, this company got screwed. Let's just put it that way, right? And it's not trading that cheap. You look at the forward P, it's way up there. Now, we'll see what happens with the company, but profitability could be a problem this year, right? And analysts are kind of all over the place with their estimates. It seems like analysts don't know what to expect from this company, right? You got a high estimate of 30 cents, low estimate of negative 35 cents. So analysts are lost with this stock. And it just seems like investors are kind of lost with this stock. The business is getting better for them, right? After they had the shutdowns. But, you're still not at a great place with this company by any stretch of the imagination. And, obviously, they just got wrecked. They got devastated. They got absolutely devastated. And that wasn't their fault. It wasn't their fault, but it is what it is. And they had to deal with what they had to deal with. The company's taken $10 billion, $9 billion, $6 billion losses. It's awful. It's absolutely awful what this company's had to go through. Sick, right? In terms of stockholder equity, back when I was in the stock back in the day, this is their stockholder equity, about $25 billion. It was tremendous. And now they're all the way down to, $7 billion. Maybe this year it's $6 billion and some change. Sad. And it's not really their fault, to be honest. It's really, to be quite honest, it's, you could say it's Rona's fault, the government's fault, or whatever, but this company got devastated. So continues to be a mess. Carnival Cruise Line continues to be a mess. And in this interest rate environment, it's just even a bigger mess, okay? Affirm stock. So Affirm, this might have some people's interest. This is about $1 away from its 52-week low at this point in time. I mean, this stock's been about everywhere, right? I mean, check this out. This wasn't even the highs the company reached, but $164. It's $9 today. $9, and it was $164. It was actually higher than that at the peak. But incredible, right? Down to a $3 billion market cap now at this point in time in regards to Affirm. No dividend, nothing like that. The hope is someday profitability. We'll see about that, right? No forward P in this company, so you don't have that to go off of. Look at the price to sales ratio. Currently it's trading in the ones. Price to sales ratio at this company was a 28. Oh my gosh, okay? What a crazy difference there. Now when it comes to financials, and we dig in a little bit here, right? 509, I mean, you can even look at the past 4 years. 264, 509, 870, 1.3 billion. So clearly the revenue's been taking off. That's great, right? Cost of revenue definitely been taken off as well. Not as much as revenue, but it's still been taken off. Gross profit for this company looks great, right? So when you just look at this, if this was all you had to look at with Affirm, you'd actually be super impressed with this company. You would. You'd be like, oh man, revenue skyrocketing, gross profit, very nice. You'd be impressed. But then you look at operating expenses, 1.5 billion. It's like, ugh, okay. Operating loss, almost $800 million. Net loss, $707 million. And the losses just get bigger and bigger and bigger. And who knows, maybe the losses are going to start slowly going down. But it's a disaster, man. It's a disaster. It's awful. I mean, just completely awful, right? And now, in regards to balance sheet-wise, about $7 billion of total assets, $4.3 billion of total liabilities on this company, total stockholder equity about 2.6. I mean, it's one of those stocks. If you are going to look at something like this, it has to be a spec play. It's no more than a spec play. It's in the same group that some small cap stock is. It's a spec play. We don't know what's going to happen with consumers. Obviously, the consumer looks like it could be getting in a better place throughout this year, but we don't know for sure, right? So Affirm's it's in a tough place. It's not really a stock that interests me. I think it's one of those companies that I think they'll find a way to make it through this mess, and they'll probably grow to become a larger company over time, but it's going to be a messy way to get there, and it's a dangerous play. So it's, in my opinion, like I said, it's a spec play, okay? RH, this is one of those companies that could be at a 52-week low after their earnings report this upcoming week, if their earnings aren't quite all cracked up to be, okay? $5.3 billion market cap on this one. P ratio looks attractive, right? 9? For a company with a growing brand, it's a high-end furniture company, if you guys didn't know, right? And in regards to this one, if we pull up statistics on this one, the bad thing for this company is they're expected to be less profitable next year than they were this past year. So they're expected to get less profitable over the next 1 to 2 years. You can take this step further if you look at analyst estimates for this company, right? 26 EPS, 24, then 17. I mean, when you start putting together back-to-back-to-back years of potentially down EPS, you can understand when the stock went from $700 to $243, where it's at today, right? Because at the end of the day, folks don't really want a company where their EPS is going down here, okay? Now, if we pull up their income statement, obviously they'll have their new numbers up here when they report their quarter here next week, and that will show what they're at right now. But they were 2.6, 2.8, 3.7 for the last 3 years here. Gross profit a little over $1 billion, 1.3, 1.8. Very nice growth, impressive, right? As far as net income for the company, 220, 271, and then they had a blow off top 688, right? The number is going to be smaller, when they finish up their numbers here in 23 next week when they release those numbers. And then the problem is that's likely going to be even smaller next year. And so that's a problem. It's like, what should you value this company at? In my opinion, how people should be thinking about a company like this is like net income $300 million-ish. That's how I would think about it, and that's how I am thinking about this, okay? And so if you're going to say a $300 million net income for this company, and let's say you slap about a 15 forward PE on this company, right? 15 forward P. So let's go ahead and pull out the handy calculator here. So we'll say 300 mil net income roughly, slap a 15 PE, should be what, 4.5 billion or so? Yep, $4.5 billion. Right now it's at $5.4 billion. So I think a 15 P is perfectly fair for this company. I just think it's trading a little rich right now. So under 200 is very attractive price point for RH. Does it get down there? I don't know. We'll see. But yeah, not one of those companies that's super exciting right now, given the obviously the environment we're in, which is luxury homes are not moving right now, to be quite frank. Okay. On its company, 52-week low on this stock. Right. This is a stock I personally own. I believe so much in this company. I believe, I've really believed this is going to be my next ELF stock. And ELF is just, it's a stock we're up almost 1,000% on. And I believe this is going to be my next one. But it hasn't shown that side of it yet. I'm hoping it shows that side in 2023. They got rid of the old CEO that was in charge here. And I'm hoping they get this baby back on track. But when it comes to this company, right, trading at a price to sales ratio right now of 0.5. Their competitors trade at price to sales ratios of 3 to 5. Okay, so I mean, the way to think about this is this stock could 10x, and basically the price to sales ratio would be about in with their competition. So that's a frame for thought, right? But the problem is with this company, we know everybody wants profitability right now. The problem is the company doesn't have a 4P on it right now. And so with that being said, and Carly's talking about profitability 2024, that's great. But I mean, just like, that's the issue with this company right now, right? When you see something like this, no one wants a piece of that right now, right? And especially when these are the growth rates that analysts have on the stock right now. 1%, 6% to lose money, that's why the stock price is having so much trouble right now. And until Carla, the new CEO, can prove that profitability is coming sooner rather than later, right? Show the exact path on how we're there, and then show why we're going to have more than this percent growth, right? Because there's no reason this business should be growing that small. We should be way outstripping that growth. Until she can show that, the stock just remains in this floundering place. And it's unfortunate, but it is what it is, right? So she's got to prove that. She's got to step up, and she's got to, this upcoming quarter will be her first quarter under her belt. And so we'll see how things go as far as that goes. She was on the last conference call. It's the latest conference call, but, it's like, it doesn't really matter because this was Nick Vlahos' last quarter. It's not like she was the boss in charge when it came to that, okay? Charles Schwab is very close to 52-week lows. It actually hit 52-week lows, I believe, last week in regards to this one. $96 billion market cap on this one. 1.7% dividend yield, almost 1.8%. So not the most intriguing dividend yield on this company, right? Very low forward P on this, 13. Like that's not, let's call it expensive at all for a company like this. If we go ahead and pull up their income statement over the last 3 years, $11 billion revenue, $18 billion, $20 billion, almost $21 billion, right? That's pretty good, right? Net income, $3 billion, 5.3, 6.6. They over doubled up net income in a matter of a couple years. It's impressive, right? And so you look at this company and it's fairly attractive. You look at their balance sheet, total assets, keep in mind a lot of these are customer assets, 551 versus liabilities 515. So real stockholder equity here about 36 billion. So, I mean, Charles Schwab, interesting stock. If from what I heard, the CEO was talking something recently here about they would be able to have deposits leave and they would still be just fine at this company. So it's actually an intriguing stock. Is it a stock I'm going to buy? I will say no. Okay. There's too many other opportunities in the market, and I'm not looking to get into a company, especially anything that I'm a little confused about balance sheet related things, because when it comes to balance sheet, everybody can show the same balance sheet, but when you get into the nitty gritty of anything financial related, like a Charles Schwab would be, that's when things get a little confusing. And so you have to have an ultra trust in the platform, the bank, whatever it is you're looking into there. So for me, JP Morgan's the only one I like to own. In kind of the finance related space. But with that being said, I don't think Charles Schwab's necessarily a bad position. The stock market's very scared right now. They think something's coming at Charles Schwab. Maybe they're wrong. Maybe they're right. I don't know. But clearly they're concerned. But also that could go for anything that is anything in the finance related space, whether it be the regional banks or whether it be somebody like a Charles Schwab, anybody that fits into that space. And speaking about these sorts of companies, First Republic, right? First Republic down to a $2 billion market cap now. It's incredible, man. Incredible, down to a $2 billion market cap. It's trading at a 2 PE ratio. A 2 PE ratio. No dividend on this one, by the way. A 2 PE ratio. Actually, a trailing 12-month PE of 1.4 and a forward PE at 2. That's the most laughable thing I've ever seen. Like, it's incredible. When you see companies trading at 1s and 2s for PE ratios, that basically it's because they believe there's some sort of systemic risk there that like the whole bank's going under, okay, and going to become worthless. And that's the thought process around that, right? And I mean, if you look at this company over the last number of years here, 3.8 revenue, 4.9, 5.7, it's impressive. Credit loss provisions in line. If you go ahead and go up to net income, we're looking at 1 billion, 1.3, 1.5. Remember, the whole company's trading at 2.3 right now. So a company like First Republic, this is a get rich or die trying stock. That's the way I'll put it. First Republic stock is a get rich or die trying, okay? Because either this whole thing's overblown and they're going to be just fine and this is going to go back to a $20, $30 billion market cap over the next couple of years and next thing you know, you 10x your money quick, 10x or 15x, or it's going to zero and you're going to lose it all. But that's kind of what I see happening with this company. It's either like, I can see the stock being a 10x stock over the next 2 to 3 years, or it's going to be bankrupt. It's going to be one of those two. So in regards to this one. So yeah, it's a get rich or die trying play in regards to that. Am I going to play it? No, but I could understand why some would want to play it from a spec side, right? Avon Brands, this stock I personally own that is right around 52-week lows right now. And I mean, to be quite honest, they don't deserve what they've gotten. They do not deserve. There's a lot of companies that do, and even some stocks I own that I'm like, I can understand why it's there, right? But when it comes to Avant, no, okay? This company's been doing tremendous. I mean, they've been growing like a weed, no pun intended. They've been growing phenomenal, 7.9, then 9.4, $20 million of revenue last year. Their last quarter was terrific in regards to this company. And so I look at Avant and I think this is probably the most disrespected stock out of the small caps. But as long as they start putting up some actual profitability, like real GAAP profitability for the EPS line, that's, I think, the moment that the stock changes everything and, it goes beast mode. But until that happens, was just kind of a waiting game in regards to that. So, yeah, guys, that was 10 stocks right around 52-week lows. I appreciate y'all joining me. Hope you got some value out of this video here today. Thanks for being subscribed. Also, make sure you join us in the Patreon if you want to support the channel. You enjoy the content I put out on this channel. Join us in the Patreon. That's pinned comment down there. And also, you can join us in the Discord if you want. And you also get to see the moves I'm making out there. Much love and have a great day.